Thank you very much, Sue. So welcome. Thank you all for making it through the snow today. If you have not gotten a chance to get the handouts, there are packets up here on the front desk. If you need one, just raise your hand. We'll get one to you. As Sue said, my name is John Ramlow. I am from Vanguard. I've been there for 19 years. I have been working with retirement plans for all 19 of those years. And one of the things that's interesting about Vanguard is we've had the same principles of investing for all 19 years. And that's not necessarily true of all of our competitors. We shut this so we get a little bit quieter there. A lot of times when I meet with people, they want to know what's the new thing that Vanguard has? What's our new approach to investing? What should they be thinking of based on what's happening now? And I tell them we haven't changed. When I started 19 years ago in orientation, they told us about our principles of investing. And it was 1998 when I started. And 1998, if you recall, in investing was the dot-com bubble. It was the start of it. If you had anything that was .com, it was the red. It was rocketing up. There was socks.com. There was pets.com. There was .com.com. I mean, anything you could think of that they could put a .com on, they were doing it. And if your business said .com, well, guess what? It was getting a lot of money invested in it. And then at some point, people realized that just because it said .com, it didn't mean it was a good investment. And I was a phone representative when I first started at Vanguard, and it was a great way to learn all about the different investments. And I would be on the phone with people, and they'd be begging me to say, go to Vanguard's people and tell them to start a technology fund. You guys are missing out. Vanguard doesn't know what they're doing. That was back when Warren Buffett, who's the well-known value investor, he was an idiot because growth was doing well and value wasn't. And people would tell me that too. The reality is we stayed true to our principles. And the thing that's really important about Vanguard's principles is that they're all focused on what you personally can control. And we don't really focus on the things we can't control. Because we just finished an election cycle, and some people were happy with the results and some people weren't. Guess what? We can't control who won. When it comes to investing, we don't really have control over those things. If the Fed increases interest rates, we can't control that. What we can control are four basic things. And these are what we're going to talk about today. We can decide what our goals are, and we'll see why that's important. We can control our balanced portfolio. So we can decide how much we're going to invest in stocks, how much we're going to invest in bonds. We can control our costs to a certain degree. We can look at the expenses of the different investments that are out there and decide whether we want to buy something that's a little bit more expensive because we feel it's going to give us a better return long term, or if we want to buy something that's a little bit cheaper, maybe an index fund, because we think that's going to work out better for us long term. We get a chance to control our costs. And finally, we can control discipline. And this is where a lot of people sort of lose it. They spend time here, they get their goals. They spend a lot of time, research, they get their balance. Then they pick the funds that meet that balance, and they get good low-cost ones. And then 20 years later, they go look at their portfolio again, and they wonder what happened. So we're going to talk about the need and the importance of reviewing it on a regular basis. And that's what balance is. Balance is just making sure that we keep 2 and 3 in mind over the long term. It's not a sexy infomercial hour-long presentation today. I'm not going to tell you how to get rich quick, but we're going to talk about tried and true rules that have worked, that are the foundation of Vanguard. These were set up by Jack Bogle when he set the company up, and it's what we're founded on, and it's what we believe in today. So we're going to walk through these, ask a lot of questions if you have them. That's why I'm here. If it's too personal to you, I may say let's hold off on that until the end and we can have a little bit more personal discussion about that. I do want to let you know that we are recording this. So if you do ask a question, if you say something, it may get picked up on the audio, or if you're moving around, it may get picked up on the video. So I just want to give that disclosure so that you know Big Brother is watching you. The other great part about that is it is snowing. It's not the best day. So if you have friends, coworkers who were not able to make it in today and they want to get a chance to view this, it's going to be out on the website.
ASEF website.
The ASEF website, thank you. So it won't be on Vanguard's, but it'll be out on Penn's website there. So that's what we're going to do today. Any questions? No? Okay, good. Hopefully the lunch is good too. It smells pretty good. So the first thing we're going to talk about is goals. When we go to invest, a lot of times I sit down with people, and it's one of the things I do is one-on-one counseling sessions with people about their retirement plans. And one of the most prominent questions I got it twice yesterday, was, I was hoping you could give me some tips on which funds to choose. And then I'll say, okay, well, what's your goal? When do you plan on retiring? Well, how much money do you think you're going to need? And they go, no. What's the best fund for next year? And I go, that's not the way we work. That's not our approach. What we want to do is we want to figure out what our goal is, and then we're going to build our portfolio around that. There's two really important things that our goal is going to tell us. What do you think those are? Time frame, exactly. Anything else? I'll give you a hint. How much money we're going to need. So once we know what our goal is, we need to know how much money are we going to need and when are we going to need that money. So if I'm a 25-year-old person and I'm just starting saving for my retirement, and I decide that I want to have $1 million by the time I turn 65, I now know that my goal is to have $1 million, and I want to have it in 40 years. Now, I can do that in a couple of ways. I can save it, or I can invest and try to reach that goal. So when I have time, I can afford to take risks in the market. I can afford to have ups and downs. It's not going to hurt me as much. If I don't have time, I can't take those risks. Because if I was investing for 5 years, and I was 100% in stocks, and we had that little thing we had in 2008, where the market dropped 40%, the S&P 500 went down 40% in 1 year, I'm probably not going to recover fully and get the benefit of long-term investing within my 5-year time horizon. So I got to look at how long I have, and I got to look at how much money I'm going to need. Now, if I'm saving, if I'm just putting money away for a short-term goal, I can be very conservative. I can put it in a bank. I can put it in a money market account. So if I'm buying a car and I need $5,000 for my down payment in 2 years, I can save that amount of money because I can physically put aside that amount of money. That's not going to be a problem. But let's go back to that example, saving for retirement. I need $1 million, and I have 40 years to get there. If I'm going to save that, if it's all coming out of my pocket, I need to average $25,000 a year saved for 40 years. It's a lot of money every year to get to $1 million. The idea of investing, we've got this gap now. So am I going to really be able to save all of that? No, we're going to invest. We're going to fill in that gap with some investment returns. So let's say I invest for my 40 years, and instead of saving $25,000, I save $5,000 every year, and I get 7% market return. Well, that's a pretty good return. It's not unreasonable to expect. I'd have my $1 million. If we drop it down a little bit, if I say I'm only going to get 6% market return instead of 7%, I only need to save about $6,500. If I only get 5% return, I only need to save a little over $8,000. In all of those cases, the amount that I personally need to put into it is a lot less, and that's because I have time to let the market help me. So when I have time, I can afford to take risk, and that risk can help me reach my goals. So the first thing we need to do is determine what we're investing for. The 4 principles that we're talking about work for any goal. It's not just for saving for retirement, but we're going to focus on retirement today. So that's the basic thing. Set your goal. This is the one that everybody loves to talk about. Yes, sir?
Well, I'd just like to ask, why is something like I need $1 million in 40 years, the right way to think about my goal? I don't know how much I need or how many years I need. I think what most people need or want is to continue, in some sense, living the way they're living now forever.
That's true. And the $1 million was strictly an example.
Right. So how do you think about that?
So when you were in your 20s and 30s, you have no idea what your lifestyle is going to be when you're in your retirement years because you haven't quite gotten to your peak earning years, so you're not quite sure what lifestyle you need to replicate. So when you're 20s and 30s, we say focus on saving between 12 and 15% of your account every year. Once you get into your 40s and your 50s, then you have a pretty good idea of what your lifestyle is going to be. And once you do that, there's plenty of tools and calculators. Vanguard has some, TIA has some, that you can put in what your current income is, how much you've saved, and it will give you an idea of how much money you're going to need to have in order to maintain that standard of living. So our normal approximation, the research shows that someone who is A middle-class American needs to replace somewhere between 78 and 85% of their pre-retiree income each year in retirement in order to maintain that same standard of living. Now, the first couple of years of retirement, you're actually above what you were spending, and then it dips down. But there are tools and things that can help us figure out what our particular target is. When we're young, really young, the most important thing is to focus on how much we're saving, and then we start to get more specific on those dollars. The thing with retirement, and what makes it really difficult to plan for, is we're not exactly sure how much money we're going to need, because we do have to figure out what our expenses are. And there's some expenses that are going to change in retirement. So if we think about our health care, the different costs that are associated with their housing and retirement, these things can go up, and they're out of our sort of realm of experience right now because we're not dealing with those things. So that's a little bit of an unknown. And the other thing that really makes it hard is we don't know how long we're going to live. And to figure out an exact dollar amount that we're going to aim for, you would need to know exactly how long you're going to live. And really, that's kind of scary if we actually knew that. So it's better that we don't. But we can get an idea. If you make it to age 65 right now, the research from last year says we're going to make it about 20 more years. So the average lifespan for somebody who hits 65 is about 20 years. Women a little bit longer, men a little bit shorter. With all of the great research that's going on around us here, that will most likely increase a little bit. So we always tell people aim for a little bit more. But you're right, when you're saving for retirement, the amount that you're saving for, the target number, is a little bit fuzzy. And I don't know if everybody remember those commercials. One of our competitors had a bunch of commercials a couple years ago, and it was, "What's your number?" And the idea was that everybody had a magic number based on their experience, what they were earning, what they spent, and that would help them. Once you hit that number, you could retire. Well, that's a nice fanciful thing, but everything changes in retirement. So whenever I use any of our tools, whenever somebody gets to their income in retirement looks like it's going to equal their expenses in retirement, I say they still have work to do, because there's always going to be additional costs that pop up that we're not aware of.
Now, I think the subcontext of that question was, look around this room.
Right.
You talked about people who are close to 60 or above who
Right.
have information about that, not what does a 20-year-old want to do.
Right, but that was, so the point of that example was to show you why you invest and not just save. So, I understand that and if you look around the room, the majority of people are closer to retirement than getting started, but there are some younger folks. So we want to make sure that we address everybody. But you're right. But what's your goal? So that's the important thing. Everybody needs to figure out what their goal is. And then you apply the other three principles that we're going to talk about to your specific goal. For someone who's younger, they're going to apply the lessons differently than you would. And that's the whole point.
Well, I'm just saying the host of this event is senior people. So just
Right.
whether you include, because everyone has sort of the same continual lifestyle. We don't
Right.
know how long they'll live.
And even, looking around this room, I've had multiple relatives live to 100 years old. So I'm looking at this room, and I think there's quite a few people who potentially have 40 more years to go, if you get to that. So it's not necessarily, but that's focusing on the one example that I just gave. So as we go through, think about how to apply these lessons to what your life is and what your goals are. Because everybody in the room is going to have different goals. Even, a lot of times when I talk to people, if they have significant wealth, they want that money to last not just for them, but for their children. So everybody's goals are going to be different depending upon your own particular lifestyle. So the second thing is to create a balanced portfolio to help us reach our goals. And when we invest for the long term, we have stocks and we have bonds. Stocks are ownership in a company. So when you buy a stock, you're taking ownership position, which means if the company does well as an owner, you're going to profit from that. A bond is a loan. So when you buy a bond, you're actually making a loan. Then over the period of the bond, you're going to get interest payments every 6 months. And at the end of the period, you're going to get all of your principal back. So if you buy a $1,000 bond, it's a 10-year bond, and they're paying 4% interest. You're going to get $20 in interest every 6 months for 10 years, and then you're going to get your $1,000 back. There's less volatility in bonds because we're not an owner. We're just going to get that interest payments. But a lot of times everybody wants to know, what's the hot fund? What's the best fund that I can get into? And as I said, when I talk to people, I get that question all of the time. And Vanguard's done a lot of research on this. And almost 90% of long-term returns are going to be based on your mix between stocks and bonds and not on the individual funds that are part of that mix. Now we're going to talk about the overall mix, stocks and bonds, and then we're going to break it down a little bit with some of the smaller subgroups. But the idea is we really want to focus on our mix. We don't necessarily want to focus on the smaller percentage, which is which of the funds that fill out that mix are going to do the best. And we can control our mix. We can't control the returns of those different funds. So this is a sample asset allocation, 90% stocks, 10% bonds. Is that a good mix or is that a bad mix? Exactly, it depends. And it depends on a lot of different factors. It depends on age, it depends on risk tolerance, and a lot of it's going to depend on wealth. So Bill Gates could be 100% in stocks, and that's appropriate for him because even if he lost half of his money, he would still be Bill Gates. I could not do that. So for me to be 100% in stocks as I get into retirement would probably not be correct. But we need to look at our personal circumstances to determine what's the right mix. Stocks have a lot more volatility. We're going to see a lot more ups and downs in the stock markets. The best one-year return in the stock market was over 50% gain. The worst one-year return was a 40% loss. So we all remember 2008. It's still relatively fresh in our minds. And people who are just about to retire, who are 100% in stocks, well, I saw some of them on TV, and they were blaming their 401k plan because they had lost half of their money. They didn't think of, wow, maybe I should have had a lot more money in bonds because I was just about to retire. Bonds do have volatility. They go up and down based on interest rates. They also go up and down a little bit on what's going on in the stock market because there's a certain amount of money that people are going to invest. And when the stock market goes down, a lot of times people are looking for a safer place to put their money. And sometimes they'll put money into bonds, even if interest rates are really low. We saw some really good returns in bonds in the last couple of years. When the stock market went down, people were looking for quality, a safe place. So sometimes you're going to get a bump in bonds that way. For those of you who are in bond funds, you probably saw some losses in the last quarter. And that was because the Fed raised the interest rates by 0.25%, and that meant existing bonds became less valuable because you could buy a new bond with a higher rate of return, a higher interest rate. That made your existing bonds go down a little bit in value. But our range of volatility is a lot less in bonds than it is in stocks. And we need to keep that in mind. For most people, when you're a long ways away from retirement, you're going to be more aggressive, you're going to have a lot more stocks. As we get closer and closer to retirement, we're going to start to sell some of our stocks and buy some of our bonds. And that's because we don't want to have those big market swings or big account swings when we get to retirement. So if we have money in stocks, we have money in bonds. If the stock market drops significantly like it did in 2008, if I have money in bonds, I can sell those until the market recovers and I don't realize my loss. So that's the one thing to keep in mind. When the market goes up and the market goes down, we don't have realized losses. We have paper losses and paper gains. It's when we sell, we compare to what we paid for it to what our selling price is. And we'll see an example in a couple minutes that shows what happens when the market's, even in a really bad market, we can still get a positive gain because there's been some time with that. But we want to keep in mind, as we get closer to retirement, we're probably going to want to become a little bit more conservative with our investments. Within stocks and bonds, there's sub-assets. There's subcategories. Some of them are bigger than others. We look at US versus international. We look at large cap companies, mid-sized companies, small companies. There's growth, there's value. It starts to get a little bit confusing if you look at this and you're not paying a lot of attention. I'm not going to go into a whole lot of detail of all the different types of funds because that really does get confusing, but we're going to talk about how they fit into a portfolio. At the grand scale of things, when we look at the stock portfolio, Vanguard's recommendations are to mirror the market. That's one of Vanguard's approaches, is whatever the market is, you want to mirror that. So the investable market in the world is roughly 50-50. 50% of the investments you can buy are outside of the US, and about 50% with stocks are inside the US. So you would normally say Vanguard's going to say buy 50% US and 50% international. There are some risk factors with international, so we're not comfortable going to 50-50, but we're going to say choose somewhere between 20 and 40% of your portfolio with international stocks and the remainder in US. Then when we look at our US portfolio, we're going to say we want 70% in our large companies and 30% in mid and small. And the reason we suggest that is if you look at the market, that's how it's broken down. Our founder used to say, it's really hard to find a needle in a haystack. So just go buy the whole haystack and you got the needle. And that's kind of what we're doing with mirroring the market. Whatever's doing well, we're going to get. Whatever's doing poorly, we're going to get. But historically, over time, the overall market has gained. And by owning it in the same proportions, we're going to get a reasonable amount of return without taking a reasonable amount of risk. Our mid and small companies give us a better chance of higher returns than our large companies do. I don't have a Coca-Cola with me. I normally do. It's one of my very bad habits. But Coca-Cola is a huge company. I've traveled all around the world, and everywhere you go, you can find Coca-Cola products. There's only so much larger Coca-Cola can get. They can roll out new products and try to get some more revenue, but they can't really grow that much larger. But if you look at a new technology startup company, it has a chance to really grow and take off. But that small technology company can face a lot of competition in the market and could go out of business. So there's a little bit more risk, but a little bit more potential return. Large companies, do you remember Coca-Cola in the 80s? Does anybody remember New Coke? New Coke was their attempt to cut into Pepsi's market share because Pepsi was making up a lot of ground on Coca-Cola. So the experts at Coca-Cola said, we're going to make our product sweeter so it's similar to Pepsi. And it bombed because the Pepsi people already had Pepsi. They didn't want to switch. And the Coke people wanted their old Coke, not the sweeter one. So Coca-Cola sales plummeted. And then they came out, and that's why if you look at your can or your bottle, it says Classic Coke because they went back to the original formula. A small company probably would not have been able to withstand that decision by the senior leadership. A well-established company can. They had some down years, but they recovered and they're fine. So the larger companies give us a little bit more stability. The smaller ones give us a little bit better chance for returns. Large companies give you global presence. If you think about GE, Coca-Cola, Boeing, large US companies that are around the world. If we look at international stocks, they also can be global. We got Michelin tires. There's a lot of other well-known brands that are located outside the US but have a large presence here. So that's why we don't necessarily need to completely mirror it. This is a little scatter shot of 12 different sectors of the market. So we have emerging markets, which are less developed commercially. Think of Brazil, Russia, India, China. So they can be large economies, but not fully developed as some of the European ones, some of the other Asian countries, the United States. Then you have developed markets. So those are the more developed international ones. We have small companies, small in the US, large in the US. I'm not going to go through all of these, but we can really break the market down into a lot of different categories. And then we can track and see which one is the best place to put our money. So let's start with emerging markets because it was the top of the list there. Emerging markets, if we look at the returns in from 95 to 2015, we've had 7 years where emerging markets was the best sector to be in. We had a 5-year run where every year it was the best one. So you might be thinking to yourself, wow, that's looking pretty good. Well, let's fill in some of the other years. We had 8 years where it was the worst. We had 2 other years where it was next to worst. Emerging markets is a classic zero or hero investment. You can do really well or really poorly. So if you're looking at this and you're saying, which part of the market did really well last year, I'm going to invest in that so that I'm going to get that same return next year, you would have had trouble with emerging markets. So let's fill in, there's our little roller coaster ride, but let's fill in all of those other categories. Now there's a very clear pattern that starts to emerge, so I'll give you a second to look at it and figure out what it is. I love doing this with people who are in school because everybody wants to find the pattern. The pattern is there is no pattern. The only consistent thing is there's no consistency in what's happening here. If you look at 1 year, it's really hard to figure out what's going to happen the next year. So when people come to me and say, John, what's the sector I should be in? What's the fund I should be in based on what happened last year, so it's going to happen next year? I say, I don't know. And honestly, if I did know, I would not be in this room with you. I would be on a beach somewhere. None of us know what's going to happen in the future. So how do we capture this? What do? Well, Vanguard thinks that the idea is diversify. Create that mix and own the market. Don't just try to pick one and outperform everybody, because the chances are you're not going to be able to do it consistently. If we get a diversified mix and choose a little bit of everything, we're going to put ourselves in a better position. So let's see how a diversified mix does. We're going to build a little portfolio here, and then we're going to stick it back into that scatter plot and see how it does. So we're going to choose one that's 65% stocks, and we're going to do 35% bonds. We're going to use 60% US stocks and 40% international stocks. We're going to do 70% US bonds and 30% international bonds. And once we build that portfolio, we put it in. And lo and behold, it's right there in the middle. It's never the best. It's never the worst. And this is the benefit of diversification. It's not the way to get rich quick, but it's a way to get reasonable returns, taking a reasonable amount of risk over your lifetime. And the amount of risk that you're going to take is going to change based on your age. So as we get closer to retirement, we're probably going to want to take less risk so that we're not putting our retirement money at risk. The next thing we can focus on is our costs. There's a lot of different ways to invest. So I've been up to Wharton. I've talked to a number of people up there. Some of our fund managers come from there. You guys have heard of hedge funds? Hedge funds are the investment toy of the rich and famous. Hedge funds cost 2% of the money that you invest, plus 20% of all profits. All of that money goes to the fund manager for managing the fund. Some of the investments that you have through the Penn plan here from Vanguard are 0.02%. So 20 times more to have the hedge fund manager manage your money. Warren Buffett is not a huge fan of hedge funds. He's made a wager with someone. He put up $500,000 of his own money and said, I'm going to pick Vanguard's S&P 500 fund Admiral shares. And you can pick any 5 hedge funds that you want and average out their returns for those same 10-year period. And at the end of the 10-year period, whoever wins gets $500,000 from the other person to go to a charity. It's not for them. And as of the last the last newsletter from Buffett from his fund, Berkshire Hathaway, the S&P 500 is ahead after 9 years. So the costs that you're paying eat into the returns that you're getting. So we want to try to keep our costs down so that we get a better return for ourselves. Every investment that you do, every mutual fund, if you do a hedge fund, whatever you do, you're going to pay a percentage of the money that you are investing to whoever it is that's managing that money. If we can keep that expense ratio down, more money is going to go into our pocket. So here's an example. This yellow, green, whatever color that is, that's going to be a fund. We're going to call that an index fund that's running at 0.25%. That's the expense ratio there. The red line, that's going to be an actively managed fund that's a little bit under 1%. So I'm going to start with $100,000 in each account. And after 30 years, you'll see that the one with the lower expense ratio looks like it's a little bit cheaper. Let's zoom in a little bit. What's the difference? The difference is about the same as the amount of money we started with. That's the impact of high fees eating away at your returns. Now, there are some good funds that are going to charge you more, that are going to give you more than the extra fees in returns consistently. But the one thing that they have in common is they consistently have lower fees for active management. Funds that charge you a lot of money to manage your money rarely consistently outperform because they have a bigger hurdle to overcome when it comes to gaining money for you. So just keep an eye on your costs. Actively managed funds, what that is the S&P 500 has 500 stocks. So I could go out and buy all 500. That's an index fund. Just buy it market weighted. I don't do any thinking. S&P, Standard & Poor's, tells me these are my 500 stocks. I buy them in the same weighting that they are in the market. I now have an index fund. Well, I'm smart, and I say, I'm better than that. I can go pick 100 of those 500 stocks, and I can give you a better return than you could just buying all 500. That's an actively managed fund. So I'm going to do my research, and I'm going to pick my 100 stocks, and it's going to cost me more money because I've got to do the research on all 500 and figure out which are the 100 that I like. By building that extra cost, now I have to give you a return that's more than that extra cost. So it's possible, but you have to watch out how much you're paying. Index funds traditionally have a much lower expense ratio. Vanguard's average expense ratio is $1.30 per $1,000 invested. The active in the industry is about $10.40 for every 1,000 you invest. So it's giving you an edge. You don't have to overcome the extra costs. Now, there are some great actively managed funds that are available through the Penn plan. So don't think that you have to do an index fund. It's sort of a misconception about Vanguard is that we're all about indexes. Vanguard has about $4 trillion in assets under management. Over $1 trillion of that is actively managed. So we certainly do not discourage active management. We just discourage active management at a really high price because you can get good people for a relatively good price. So that's our first three things. Know our goal, build a balanced portfolio, preferably a diversified one, keep your costs down, but once you've done all that hard work, don't stop. Keep an eye on it and maintain discipline. And I'll show you why that's so important. So let's say we've done our research, and based on our age and our risk tolerance, we're comfortable with a mix that's 60% stocks and 40% bonds. Well, if I don't do anything, if I had that 60-40 portfolio mix and I just let it sit there, and I started 4 years ago, I'd probably be higher than 75 stocks right now. But over time, your portfolio is going to go up or down, your percentages in each category, based on what the markets are doing. And a lot of times, when the markets keep going up, we want to keep our money in stocks because it's been doing well and we want to keep it there. But sometimes we want to think about selling our winners and buying our losers to get back to our mix. So let's do a little example here of what happened in 2008. We'll use actual numbers. So if I wanted to be 60-40, what would happen if I got to 75-25 and hadn't made any changes? So you guys remember 2008, right? We had a little market correction, dropped 40%, started the Great Recession. So if I was 60-40 in 2003, and I didn't do anything until 2008, the bottom of the market, and then I sold out and went into bonds. And this is a real example. I've seen a number of people who did that. And then they were afraid of the stock market, so they waited to get back in, and they just left it there through 2013. So from 2003 through 2008, the end of 2008 really, they were all in. They started 60-40. They actually ended up above 75-25. Then they went to 100% bonds. And they still got almost 70% return over that 10-year period. So they averaged out about 6% per year. It's an 11-year period. That's not horrible when you consider that we had 2008 in there. But they got great returns for those first 5 years before 2008, and then they locked in their account where it was. What would have happened if instead they had said 60-40 is my mix, and every 6 months they went back into their account and they rebalanced it to get back to 60-40? How do you think that would have impacted those returns? They would have lost out on some in the beginning because the guy who didn't make any changes kept getting better and better stock returns, and then he froze. Well, if you actually rebalance over time, you would have done almost twice as well. And that's because you stayed where you were selling your winners, you were locking in some of your gain, you were buying your losers, so when the losers recovered, you got some benefit out of there. Rebalancing really is important to your portfolio. It's also important because there's a psychological point where we're comfortable with our investments, and there's a point where we're not comfortable with our investments. And if 60-40 stocks bonds is your comfort zone, and you get to 75-25 or 80-20, and the market corrects, your percentage change is going to be a lot higher when you're 80-20 than it would be 60-40. And that might cause you to make a change and to sell when the market's down instead of being able to ride it out. So there is no one perfect asset allocation that works for everybody. You need to be comfortable with what it is so that when the market corrects, you're not going to overreact when you see your account balance change. And that's why a lot of people, when we're younger, we're comfortable with a lot of risk because, quite frankly, it doesn't really matter to us because retirement's so far away. But as we get closer and closer to retirement, and I found that 50 is sort of that magic tipping point, people start to become a little bit more concerned about preserving what they have instead of thinking about continuing to build what they have. So we want to have a mix that's going to give us a little bit of both. So we want to have goals, we want to have balanced portfolio, cost, and discipline. How do you do that in the retirement plan? This is nice in a vacuum, but let's see, there's two ways we can do it. Does anybody here drive a car with a manual transmission? A couple people raising their hand. Why do you do that? Always have? You like it. It's fun. There's more control, right? You get a chance to do different things. Who's lazy like me and has an automatic transmission? Yeah, I do it because I drive on the Schuylkill and I think my knee would fall off through the number of times I have to clutch if I drove a car with a manual transmission. Same thing in investing. You can have something done for you. You can have someone do the switching for you, or you can do it your own. In what we've handed out, there's information on both ways, and I'm going to go over them in just a second. But the investor questionnaire, this is the manual, going to help you with the manual transmission approach. It's going to help you create a mix based on answers that you're going to give. It's 11 questions. We'll talk about it a little bit more, but it's going to give you a mix that you're going to have to monitor going forward. The other option is a target retirement fund. This is your automatic transmission. Vanguard's going to do the shifting for you. Which one is better? It doesn't really, there isn't one that's better or not. It's what one works best for you. The other thing you have is our quick start guide. There's just a couple of phone numbers on there. Don't spend a whole lot of time on that. But let's talk about the two different ways we can do this. First, we're going to start off with the automatic transmission approach, the target retirement funds. And we're going to see how it takes all four of Vanguard's principles and puts it into one investment. So we've got the target retirement funds. Each Vanguard target retirement fund invests in 4 and then a 5th Vanguard mutual funds. They have the total U.S. stock market index, all the different types of U.S. stocks you can buy, market weighted. The yellow is the total international stock market index, all of the different types of stocks you can buy outside of the U.S. This dark blue is the total U.S. bond market index. The light blue, medium blue, total international bond, and these are Treasury inflation protected securities. Those are short-term bonds that adjust in price. Yes, sir?
Does, for the Penn target funds, does Vanguard charge an extra expense over the
No.
usual expenses of the fund?
Now, the way the target date funds is the expense ratio is the combined aggregate of the underlying 4 or 5 funds. There's no additional cost for the adjustment over time. And that's for Penn, that's for everybody. So when you buy Vanguard's target retirement funds, the expense ratio is the combined aggregate of the 4 or 5 underlying funds. There's no additional fee for doing the adjustments over time. Because quite frankly, that's computerized. So there's not a need to charge extra money for somebody who's already programmed it, let's face it. Some companies do. There are certain companies that do that. We do not add an extra fee to do that. Because once it's programmed into the computer, it's done automatically. I mean, they look at it every night, but yes?
So, but there are investor shares and admiral shares. And they're great.
The target retirement funds, if you look at the names, the ones that are available through Penn, they're the institutional target retirement funds. So investor shares are the normal share class. Admiral shares are for those with a little bit higher balances. Institutional shares are available only to institutions who commit a certain amount of money. So the target date funds that you have here, you have the institutional shares.
Oh.
Yeah. So the expense ratios on these are 0.10 or 0.09%.
So that's the lowest possible?
Of the funds, yes.
Oh, that's great. Yeah.
So yeah, it's a very low cost investment, and there is no extra cost for the the managing and keeping the balance the way that we want it.
Is that general that the funds through Penn are lower cost than other funds, sort of the individual investor funds?
Some of the funds are investor shares, some are admiral shares, and some are institutional shares, and part of that comes down to the way that Penn pays Vanguard. So in some of the funds, there are investor shares, and a portion of the expense ratio from those investments goes to pay for Vanguard's administering the retirement plan, and some are in institutional, and they figure out how much money it's going to cost. The other way, Penn could ask you guys to pay a monthly fee or a quarterly fee to cover the record-keeping services. Some plans do that. Penn has instead decided to take a portion of the sum of the funds and use that to pay for the expenses of managing the fund.
So but the institutional rates are lower.
Yeah.
To the admiral.
Oh, the institutional is even lower than the Admiral shares. So if you were to look at if you were to go and look at the expense ratios online, the Admiral shares on these are about 0.13 and 0.14. The investor shares are 0.16, I believe, and the institutional shares are 0.10 and 0.09.
Is that general for all your funds?
Yes. So we've got our balance. We've got our balanced portfolio. We just talked about the expenses. So the target date funds are very low cost in order to get this full balance, and we have discipline. They actually get rebalanced every single night. So we take a look at the cash flow in, we look at redemptions out, and we look at market changes, and computers readjust these every night so that they maintain the target date. The way they work is you just decide roughly when you either want to retire or when you need the money, and then we adjust the amount of stocks and bonds based on how far you are from that target date. This does not take into account how much money you have. It does not take into account your personal risk profile. It is strictly done based on your age. And that's a good indicator. It's one of the 11 questions we ask when we do the investor questionnaire. But this is sort of a generic way to do it. It's a very intelligent way to do it, keeping costs down, being broadly diversified. I mean, this is a globally diversified, balanced portfolio for a really low cost that automatically adjusts. You never have to look at it again. It's the automatic transmission, but that doesn't necessarily mean it's right for you, because you might want to choose your own investments. Now, my legal department would yell at me if I did not take a moment here to say, all investing is subject to risk, including the possible loss of your principal. And target date funds are no different. When you invest in a target date fund, we are not guaranteeing a return. What we are doing is we are providing you with a balanced portfolio that we are going to adjust over time based on how we feel you should be invested based on your age and how far you are from your retirement date. So that's the legal department. Now I don't get yelled at. It's on tape that I did it, so that's good. The second way to do it, those of you who like to drive the manual transmission car, those who like to have a little bit more control, we can take the investor questionnaire. It's 11 questions. The first question is, I plan to start taking money from my account in how many years? So this is going to how far we are away from retirement. But there's other questions in there that are going to ask you how you would react during certain market activity. So we're getting to know you a little bit more. So this is a little bit more personalized approach. Then we're going to give you a score. So you self-score it. You look down, you figure out where you are. Once you get your score, you look across, blues or bonds, reds or stocks, and you'll get a suggested mix between stocks and bonds. In the handout that I have you that's inside there with the score sheet, you're also going to get a suggestion of large cap U.S. stocks, mid and small cap U.S. stocks, international stocks, and U.S. and international bonds. So we're going to give you a suggested mix. These are all suggestions. When you decide to do it on your own, you're free to mix and match and do whatever you want. You can be more aggressive than we suggest. You can be less aggressive than we suggest. So it's all about making sure that you pick the right mix. Once you get your mix, then you choose your funds to fill out those different categories. And then you need to maintain an eye on that. And your target date funds are all index. When you're doing it on your own, feel free to look at the actively managed funds as well. There's a lot of great tools that we have available to help you out. I don't know if any of you have smartphones. Our Vanguard app is actually really helpful. I kind of mocked it when it came out. I'm like, who needs an app to look at their account? But it does a really nice job of breaking down your account. You can see your asset allocation, your sub-asset allocation. We've also got a lot of great tools on our website. So if you go to vanguard.com/retirement, that's to go into where you can log in to see your Penn accounts, the Vanguard app. If you want to call and ask a question about your account, 800-523-1188, which is on a number of the pieces of paper, gets you to our participant services department. They're the ones who answer the quick questions. What's not up here is the other website that's important to know, and that's meetvanguard.com, and that's MEETVANGUARD, all together.com. And that's the site that you can go to register to do a one-on-one consultation session with me. So I'm here on campus 5 days a month. I'm at the Smilo Research Center 1 day a month, and I'm up at 3401 Walnut 4 days a month. And on occasion, I'm other places too. But you can come in, we can sit down, we can talk about your accounts. I cannot tell you what to do. I'm not going to advise you. I don't know enough about you. I'm not going to be able to, in 45 minutes, know enough about you to meet the legal requirements to be an advisor. But we can certainly talk about your investments. If you have questions about what's my asset allocation, does it seem to make sense for me, you can tell me what you're looking to do, and we can talk about those different things. So it's meetvanguard.com. You can set up appointments with me. So Lou Kakamo, who's from HR, is in the back, and he would yell at me. A lot of people want to yell at me if I don't do the right thing. So Lou would yell at me, and if I did not say that TIA is also on campus, and how would they sign up if they have TIA and want to meet with them? So you can get two different opinions. The great part is I talk to people who have no money with Vanguard, but they see I'm going to be on campus, and they come in and they just want to get an idea of what Vanguard thinks that they should be doing. That doesn't mean they're going to move any money to Vanguard, but they just value a second opinion. If you have your money with Vanguard, you want to get a second opinion, talk to Tia. We're not afraid of the competition. We feel we've got a great product. They think they do too. So it's a very good situation for you guys. You have two very strong places that you can look to get information. And once again, I got to put this one up one more time, and then we'll get to all the questions. This is my legal department again. So once again, all investing is subject to risk, including the possible loss of your principal and some other things there. So there, now I've done that. Now we can get into Q&A. Yes?
You know, I was just curious, you mentioned TIA. Do they do target retirement date funds also?
So TIA does have their version of target date funds. Target date funds were started by Fidelity. Fidelity came out with an actively managed version of a target date fund that had, I believe it was 26 different mutual funds that were part of their investment mix. Because they were using 26 actively managed funds, their expense ratios were significantly higher than ours. Vanguard did not have them at the time, and Vanguard looked at that and said, that's a brilliant idea. We just think it's executed poorly. So that's when we decided we would go with the broad-based index funds. We have a group called Portfolio Review Group. They look at all of our funds. They consistently remodel these target date funds, and they throw in different ideas. And what if we added this in? What if we added that in? What if we overweighted this part of the market? So they're consistently looking at it, and they've continued to say the 4 broad-based funds plus the tips just before retirement still seem to make the best sense. TIA's version, I believe, have about 20 or 21 different funds. And what they're doing is they're picking individual funds for all of those different sectors of the market that we talked about. So they're going to have a large cap growth fund, a large cap value fund, a small cap growth fund, small cap. So they have all kinds of different funds that hit different sectors of the market. We just keep it simpler and, as a result, keep the costs a little bit lower. But they do offer them, yes.
No, I see. That's really interesting. That's sort of what I was going to ask. I was going to sort of say, like, by the way, so there's this color thing in your brochure, which I think is just wonderful. This is just what I wanted.
Oh, great.
I couldn't find it on the web. Maybe it's there, but at any rate. So, but I mean, so this is like a summary statement of sort of exactly how you do your target.
Exactly.
But along the lines of what you were just saying, has this picture been frozen for the last 15 years, or
No.
is it changing the way you do it, and how does it compare to the competitors?
So the biggest change that we have made in ours is if we look at the glide path, as we call it, if I was here 2 years ago, the red would be up to here. We had 80% of the stock portion in the US and only 20% international. The Portfolio Review Group reviewed that, and they decided that the overall market was roughly 50 US, 50 international. And we were 80-20. So we were pretty far away from what the market was, and that goes against our principle of owning the market as it is. There were reasons, and some of it is liquidity of international markets, some of it's stability of international markets. But they reviewed it and they decided that we really should go to 60-40 instead of 80-20. And it took an entire year, because we don't just, when we make a change like that, it would cost the shareholders a lot of money to just go out and make a big trade. So at the beginning of 2015, we were 80-20. At the end of 2015, we had gotten to 60-40. And what we were doing is we just didn't buy any new US. All the new money that was coming in was being invested in international. So we did the slow adjustment till we got there. If you looked at our competitors, they would have a whole bunch of different colors. The overall risk profile is surprisingly similar. And if you went to a session like this with TIAA, their approach to investing is fairly similar. I've talked to the folks at Fidelity. Their approach is fairly similar. There's some minor differences, some granularity in there that what they focus on compared to what we focus on. But overall in the industry, most of the major players, the thought process and the general principles are the same. And part of that is good for us because we all kind of have the same concepts. Because of our ownership structure, we're able to keep our costs down a little bit, and that's why people like us. But that we're not more brilliant than they are. I wish we were, but we're not. I've got one here, and then we'll go to the back.
I like the way you talked about a balanced portfolio. I'm just wondering how you factor in the rest of what we have to deal with, whatever it is.
So anything that's illiquid, like when you're looking at your retirement portfolio, we ignore real estate. Unless it's a rental property where you're getting regular income, and then we'd look at that as sort of a bond because you're getting an interest payment you're getting sort of income from that. Rather than being interest on a bond, you're getting income from your renters. So if you have rental real estate, we would sort of look at that as a bond holding. We do include cash when you're looking at an overall portfolio. You don't see it in here because when you're investing for retirement, we don't normally look at cash. A lot of times people will hold cash because they're waiting for an opportune moment to invest that cash. So they'll say, well, the market's high right now. I don't feel comfortable investing my money right now, so I'm going to leave it in cash until we get a correction, and then I'm going to invest it at that time. Our approach is just invest it now, because even what looks like a fairly decent sized change today, if you're investing for the long term, 10, 20 years, the size of that blip becomes smaller and smaller over time. But cash can be an important component, especially in retirement. This light blue up here, the Treasury inflation protected securities, those are short-term bonds that adjust in price so that you don't lose money to inflation. That's basically the cash component of the target retirement fund. And when you're in retirement, you want to have 1 to 2 years worth of expenses in a cash-like equivalent or cash itself. And that's because you need something to spend. And if the market goes all haywire, you want to have enough to spend and give the market a chance to recover. That's a technical term, by the way, market going haywire. Does that answer your question? Okay. And
One more variable than I hadn't thought about. The age of retirement hasn't changed over the years. Distribution is the same. But the age of the mod has changed.
right.
So how do you adjust, or do you adjust?
Well, that's going to be your personal, and a lot of that comes to what you're setting your target date as. So with people living longer, we're often working a little bit longer as well. And that just means you're choosing a little bit later target date. But when you think about thinking about how long you're going to live, and that's one of the, if you look at the investor questionnaire, one of the questions is, I expect to live, it doesn't put it this way, but it says, I expect to be taking money from my account for X number of years. But basically that means I expect to live this long. And that is an important factor. One of the things that we talk about with people who are close to retirement and in retirement is how much of your portfolio can you take out on an annual basis? How much can you spend and have it last? Well, there's what's called the 4% rule. It's a guideline, it's not a rule. And that basically states that if you take 4% of your account balance the year in which you retire and you adjust it based on inflation every year thereafter, your account should last 25, 30 or more years. which gets most people through their retirement. But if you come from a family of really long livers, you might want to go to 3% as your withdrawals. And the other thing is, we want to be flexible in our spending in retirement. Because if you have a rigid budget that you have to spend a certain amount of money, if the market goes down significantly, you can't adjust that. But if you have a lot of flexibility, you can reduce your spending in market downturns and increase it in market upturns, and that will make your money last a lot longer. So this is why we keep 30% of the money in stocks even 7 years after the target date, and that's because we want the money to continue to grow and work for you no matter how long you live, but we've moved a majority into bonds so that we're getting income. If you think you're going to live 40 years in retirement, you might want to bump that up to 40% stocks to give yourself a little bit more growth. So that is an important factor. And it's also a very important factor when you're deciding when to take Social Security and other things like that, because the sooner you start taking it, the lower your payment is. If you wait until 70, you get your highest payment. But if you have a family history of everybody dying at 75 and you wait until 70 to take Social Security, you're losing money. So you really have to look at your overall family history, your financial history, and make it the best decision that you can make for yourself. But you're right, we are living a lot longer, and that's why we need to keep some of our money invested. My great aunt lived to 100, and she still had a little money left over. Let me get back here, and then I'll get back. Oh, yeah.
As a respectful user of that site, I've tried to go on that site a couple of times.
Okay.
I've been given the merry-go-round. I've tried to call that number to report the merry-go-round or to get home, and I got a merry-go-round on that number.
What were you trying to get into the website itself? Yeah, that's. I'll give you a secret. Hit 0. Once you get through, once you put in your information, when it asks for what number, just hit 0 like 3 or 4 times, and eventually it short circuits it and jumps you off to a person. I know this because I do that. Yes, sir. Red, yes.
So I'd just like to ask about timing of the market, which, like many other people I've been listening to for the last 30 years, have said, don't try and time the market. But it seems counterintuitive because, as the market goes up, so the risk of it plateauing goes up. So therefore, at any particular time, you may not know when it's going to plateau, that's fine. But you can certainly know that there is more risk as it goes up. And conversely, as the market is going down, similar but opposite effect obtains. I don't understand why one cannot specific rebalancing of stocks versus bonds in accord with that risk at various times.
Well, you can do it manually. Systematically, we're not going to do it, and one of the reasons we're not going to program our systems to do it is that goes completely counter to Vanguard's philosophy on investing, and it also goes contrary to all of the research that's out there on investing. It sounds very, very intuitive that you should be able to time the market fairly easily based on what's going on. But there were a lot of, we can just look at the last 6 months. Leading up until the election, the market, so to speak, had priced in a Clinton presidency because that is what was expected. And then when President Trump was elected, all of a sudden there was going to be this huge volatility because nobody knew what he was going to do. And the market was going to drop. Everybody said get out, and if you did that, well, you missed out on a pretty good run. It's always easy to see the trends in hindsight. It's virtually impossible to consistently do it with foresight. And that's what all of the active managers are trying to do. They're all looking at the different investments that are out there, and they're trying to time their purchases with a lot of research. There's a lot of brilliant people who are doing it, and all of the research shows that 80 to 90% of the time, they fail to outperform their benchmarks consistently. So that's why we say, don't try to time the market. Do you dollar cost average into the market when you do your regular monthly payroll contributions, and over time you're going to get a better average price than if you do try to time the market. And there's some people who time it right a couple of times, but you get it wrong once and you eliminate all of those great gains that you did. So it does seem like it's something that you should be able to do. And we get our fund managers come in and talk to us all the time. So at the beginning of every year, a lot of the fund managers come in, they come into conference rooms and they talk to everybody who talks to people about investing. And they start off with the postmortem, why their brilliant ideas from last year didn't pan out. And then they'll tell us what they're going to do next year. And they can't, when you listen to these guys, they can't miss. The research they've done, everything that they have sounds dead on. And then again, the beginning of the following year, the things that happened that they didn't expect that threw them off. And these are the active managers, and Vanguard hires the best of the best to help us manage some of our funds. And the good news is a lot of our active managers do consistently outperform their benchmarks, but a lot of it is because we force them to do it for so cheap. But they're still not outdoing the market by significant amounts. So it does seem like something that anybody could do based on what's looking out there, but the history shows, and the research shows, it's not a winning strategy. Yes, sir?
I would have interpreted that question differently.
Okay, excellent.
Most active funds are people trading individual stocks, and rather than an index fund. But are there active traded target funds? That's more what the question was. Whether you shifting in
Most of
relationship to.
There are actively managed balanced funds that the fund manager will go in and try to, so most mutual funds that you buy have a preset target. They're going to be going after a certain part of the market. There are a few that are total market funds, and the fund manager has the opportunity to try to go in and out of different sectors as they feel fit. Historically, those have not done very well. Target date funds traditionally do not do that. They will set their glide paths like this. Many of our competitors, again, will have 20 to 30 different funds in their glide path trying to hit the different subcategories, but they're not going out and adjusting how much is going into each subcategory. They have a path that they're going to stay to that they feel is appropriate. But even the total return funds, which some places will have, which gives the fund manager total freedom to choose the asset category and the weighting into each of those, and then all of the sub-asset categories, even those types of funds historically have not outperformed the market. So there are funds that do that. Historically, they have not been winners. Actively managed funds. So you have a fund manager who has total control to either choose mutual funds. In some cases, they can choose individual securities. In all of those, they haven't consistently outperformed. I'm going to go here, then here.
So on rebalancing, if you just did a rebalance where you said, okay, I'm overweighted, so I'm just going to buy this one, I would assume there would be no cost implication.
Correct.
Suppose you said, I want to do it all at once. Is there a cost implication within the retirement funds if you say, I'm going to
There's no.
20% of this and buy 20%?
No, there's no charge for you to do that. We would say set sort of guardrails that if you get more than 5% beyond what your target is, to go in and do a rebalance there. So, the reason you don't want to do it, you get 3 or 4% off, then you're spending too much time on a small change. But if you get more than 5% or so, and you can set your own guardrails at 5, is it 10, you can go into the website and it's relatively simple you just hit rebalance to match what your contribution mix is, and it does it right away. So it's pretty simple to do, and there's no cost to do it.
Corollary, if you were to go from the retirement actively managed funds to say, okay, it's time, I want to put everything into that. Is there a cost basis there as well?
There's no cost to do it. So some people will look at it and they'll say, I dollar cost averaged for my entire life to get all of this money into the account. And taking all of that money and changing it all at once doesn't feel right, because if I catch the wrong day in the market, it's going to cost me a certain amount of money. We have had some research done by our group, and they have pretty much decided that in most cases, it really doesn't matter if you say, I'm going to move from actively managed into the target date funds and do it 10% for the next 10 months, or if I do it all at once. The long-term impact of that does not have much of it, really doesn't impact your long-term success rate. So that's, right now, that's where we are. I'm going to go here and then back there. So Vanguard doesn't do annuities. We do have an annuity platform on our website. Annuities are a great way to get a stream of long-term income. The downside of annuities is they often come with fairly high costs, and you give up control of your principal. A properly managed portfolio can give you the same type of income that an annuity can without giving up the principal. So if you take $250,000 and buy an annuity, there's going to be a cost to actually buy the annuity, and you've given your $250,000 away. If it's a single life annuity, something happens to you in 2 years, all of your money is gone. If you kept it in a mutual fund and set up a distribution schedule that would probably be similar to what you could get as the guaranteed return on an annuity, something happens to you, you'd probably still have $200 and some thousand left you could pass on. I feel annuities are fantastic if you have someone who is very poor at managing money and is going to spend all of their money. So in order to be, it's like a spendthrift provision. If you buy an annuity, you cannot outspend it. You're only going to get a certain amount every year, and your money will last for the rest of your life. The other place where annuities are very helpful is if you have special needs people in your family, if there's situations where you need to be sure that you can provide a certain amount of income for the life of that person, then an annuity can be a great option. But in general, they tend to be an expensive option that you don't really get the extra value out of the extra money. Yes, sir.
So again, having to do with risk, given that the rebalancing, as you suggested, every 6 months is a way of attenuating risk in the market, what's special about 6 months? It's just been modeled, should it be every 6 months? Is there an advantage to thinking about doing it more frequently? What's the option?
Well, we did 6 months for that example because it's an easy interval to use. What we would say is look more at how far you get away from your target asset allocation mix. So if you never get outside of whatever guardrail you want to set, 5, 10%, then you never need to readjust. The idea is when you get farther and farther away from your goal, you're going to be much more likely to make a decision that is contrary to what you really want long term. So by setting, we've used 6 months for that example, but I would say use a 5% guardrail. So if you set your target asset allocation at 60 stock, 40 bond, and you get to 70 stocks, 30 bonds, you're more than 10% away. If you had rebalanced when you got to 65, 35, then you would be able to get back to 60, 40, and you're staying where you want to be. So it's not necessarily a timing issue. It's a how far away from your target are you. Some people don't want to look at their account on a regular basis. So you look on a quarterly basis or a semi-annual basis, and that's where you can get 3 or 6 months. But the actual when you should rebalance is really more based on how far away from your target you get as opposed to a frequency approach. To your left, or to your right, there was a question.
Any advice about putting investments in stocks versus bonds in pre-tax retirement accounts if you expect higher rates of return? Stocks is better.
So first, I don't give advice, but from a guideline perspective, you want the money that you have that you think is going to grow the most, you want in a tax-sheltered account. Because if you're getting large capital gains that you would be paying taxes on, if it's in a taxable account, it makes more sense to keep it hidden behind the tax shelter of the retirement plan. So if you have a taxable account and you have a tax sheltered account, you want to put your more aggressive, more highly taxed investments in the tax sheltered account so that you're not paying as much taxes. And you can do a lot of math, and the question is, if you have pre-tax money that's in a tax sheltered account, what tax rate are you going to be paying when it comes out? If it's in a taxable account, you're paying capital gains rate, which is lower than some of the marginal tax brackets for regular income. So there's a lot of work that you have to do to decide, and that's why I say I don't give advice, is when you're looking at taxes, there's a lot of things that go into deciding where to put your money. But as a general rule, you want your higher returning investments behind the tax shield. Well, yes, sir.
Penn, you indicated, I've heard before, Penn has particularly favorable low expense ratios for Vanguard funds.
Correct.
At least some of them. Is there any difference in that advantage whether you're working or retired, or do those stay the same?
While you're still within the Penn plan, everybody gets the same expense ratio.
So it's your 403B after you're retired, you continue to get the same.
That's correct. Yes. Yeah, the investments stay the same. It's just once you leave, if you were to leave Penn and take the money, if you retire and you decide to consolidate everything into an IRA, then you'd go back to probably the Admiral shares. Yes, sir. Yes. So it doesn't really impact your investment decision. It is going to, when you reach 70 and a half, for those who aren't aware, if you're no longer working, you're going to have to start taking money out of the University of Penn account. Even if you still are working, if you have IRAs, you have to start taking distribution from those. And if you have money from other employers, you would have to take it from there. And it's part of the tax deal you get from the government. They agree to defer your taxes for a certain amount of time so that you're saving for your retirement. But at 70 and a half, they've decided they've waited long enough. So you're going to give them about 4% of your account balance has to be withdrawn. A lot of that, when you're looking at your overall account portfolio, if you don't spend the entire amount that you withdraw, you can then reinvest it to keep your asset allocation there. But as far as how you create your investment mix and what you're doing with it, whether you're taking distributions or not, really shouldn't impact the way you're setting up your asset allocation. Yes?
Related R&D question. I had an IRA that I rolled over to a supplemental PIA plan.
Okay.
Avoid that. I had a lot of trouble dealing with Vanguard to find out whether this was possible, and it turned out I couldn't. They still have, to me, you have a 403B in both places. Is there a reason why we can't roll over stuff into a supplemental plan and a 403B?
So there are certain, the rules of what can and can't go into the plan are set up by Penn, not by Vanguard. So whether something is accepted or not, they sign off on any rollover that comes in. A lot of times the reason that traditional IRAs, if it wasn't a rollover from a previous employer, are not allowed to be rolled in is if the IRA itself was somehow deficient. In other words, if you were not allowed to claim the tax deduction and you did, and that money comes into the plan, technically it could disqualify the Penn plan. So they're very careful about money that goes into the plan to make sure that the plan itself stays intact. But for that particular situation, I'm not exactly sure. Which is interesting because, I mean, the rules as far as what can be rolled over and what can't should be the same. Any other questions? I know we're getting close to our timeline and people are sort of heading out. Well, thank you for coming today in this lovely weather that we had. And I appreciate it. And if anybody missed it, they can always sign up to watch the recording. Actually, they don't have to sign up. They can just watch it.
John, thank you so much.
Thank you.